Hello everyone. Today on the Final Bar, I'll be talking with Mish Schneider of MarketGauge. We'll see what charts are top of mind for her, including her modern family, a great review of some of the big picture asset classes and areas of the market where we should be focused. Ladies and gentlemen, this is the Final Bar. Hello everyone, welcome to the Final Bar. I'm your host Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts, the technical analysis toolkit, which our Chief Technical Strategist, John Murphy, really helped to pioneer years and years ago and proliferate around the financial industry, is designed to help you understand the markets. These are challenging times, and anyone that implies that it's easy to get a read on these markets, I think they're lying to you or to themselves or both. This is a tough market, and I spent a lot of my days talking with people who are pretty seasoned investors, successful traders, people like our guest today, Mish Schneider, and I will say it's not all clear cut. But what's great is the technical toolkit, which we will be talking about quite a bit, as we do usually, is designed to help you think about risk versus reward. And while that's something you might have read about, while that's something you probably learned about at some point, these are those times when it's really important to combine them. It's easy to get away with bad habits in a year like 2021 when everything's long and strong up and to the right. Now it's when you really have to earn your keep trading these markets. Let's get to some of the charts and see what questions we can answer together in our market recap. As we're looking at the S&P 500 here today, closing around 3960, that's up about 1.8% from where we finished today yesterday. The NASDAQ composite pushing even higher, up about 2.5%. It's just below 11,720. All the major indexes that we track in the green, the mid cap and small cap groups up as well. You know, small caps at I think it was earlier this week, might have been yesterday, dramatically underperforming. Today it's actually a little more in line, right? Everything's sort of moving to the upside, and it's so funny. Just in this 8-hour period, we've had dramatic shifts from, things are going horribly, and all of a sudden there's another bank certainly under question, and all of a sudden news from Switzerland about Credit Suisse, and all of a sudden by the end of the day, it's no, everything's fine, things are good, the risk assets can move to the upside. That is a summary, that is a microcosm of what this entire market, I think, certainly feels like. So while today certainly feels like more of a risk-on day, if you look at the sectors that are leading the way higher, sort of the FANG and FANG-like sectors, the growthy stuff for the most part, that's doing the best. Financials, even in the top 3 by the end of the day, but these are coming up from pretty beaten down levels in a lot of cases. So let's look at some of those charts in a little more detail. We'll start thinking about volatility before we go to some other asset classes. The VIX continued to come down a little bit, down about 3 points from yesterday. Yesterday it was up in the 26s. Now it's down to 23. Still what I would sort of label as excessive volatility or a high volatility environment. And for me, the general way to think about that is it above or below 20? VIX above 20 tells you in general we're kind of in a volatile period. Kind of above 25 is where you get to more extreme volatility. Below 20 is sort of a low volatility environment, again, using sort of the historical reference of the last year or two. So interesting to see if we remain in sort of that volatile environment with the VIX remaining above 20. For now, it's certainly seeming to be the case. Looking at some other asset classes, I know I'll be talking with Mish in a little bit about the fixed income markets, certainly an area of focus. What happened today? Long end of the curve came down, went up a bit. So bond prices came down, but the 10-year yield actually moved a little bit higher. So up to around 359, we'll call it. The dollar index, not too much change from yesterday, but I think that dollar chart is one we've certainly been talking about, thinking of the interplay between interest rates, the dollar, precious metals, where we'll get to here in a moment, is pretty important as well. We highlighted a chart of the TLT. I don't know if we're going to have time to get to it in the market recap today, but down about 0.75% from yesterday's close. Commodities mostly in the green as we're looking at the closing prices here, with the gold ETF up about 0.2%, silver moving down by about 0.4%, so not too much of a bad day. Energy overall sort of hanging in there. Interesting to see how much energy prices have come up, particularly crude oil prices, breaking down through recent support. The USO now sitting right around $60 a share. That's for the crude oil ETF, which we like to focus on. Finally, cryptocurrencies, 10 out of 10 of the top coins that we track on the StockCharts platform, all in the green. Bitcoin up about 2.5% from yesterday. Ethereum up about 1.5% to 1680. Bitcoin is actually teasing that 25,000 level. We'll see if we can get to that chart here in a moment as well. Let's start with a daily chart of the S&P 500. We like to like to focus on this chart every day on the show because I think it's a really good way to illustrate how today's movement fits into the big picture. So I would encourage you, if you're just getting started with this form of analysis, what we call technical analysis, really thinking about market structure using analysis of trends and momentum and price action, I would strongly encourage you to think about the market in multiple time frames. It is very easy to get your blinders on, just focus on one particular time frame and imagine that that is the game, right? That's the window that you're looking at. But you have to remember that time frames, the markets really are fractal, meaning there's a shorter term and longer term time frame, no matter what particular chart you're looking at. So the rally that we saw today, decent up move, what did we learn? Well, the S&P closed back above its 200-day moving average. Now, while that's not an all-clear sign where you will hear me say, all right, long and strong, obviously we need to be incredibly bulled up because the S&P is back above their 200-day, it's not a non-issue, right? And in general, I was taught nothing good happens below the 200-day. And that was a quick hand way of just saying, if you know nothing else, just look at where the price is, the stock or the ETF, relative to the 200-day. Above or below it is just a very basic measure of trend, because if something's in an uptrend, it's going to be above the 200-day moving average. That's by definition. That's how those things are actually calculated. So the S&P getting back above its 200-day could be an interesting thing to watch. Certainly would want to see if there's a follow-through day to the upside tomorrow. So today, Thursday, see on Friday if we can get a higher close going into the weekend. That could be a pretty encouraging sign for further strength to come. But for now, we consider it a nice bounce off of the lows. Look at what's happened here. Again, the further we bounce off of that 3,800 level, the more it looks like, for now, at least, a retest of the December lows, right? December, we bounced off of 3,800. We pushed to a new swing high just below 4,200, then stalled out, came back into this blue shaded area, this sort of congestion area. We went below it, retested it from below, and then broke below the 200-day moving average, taking us right to the December lows. One of the things we talked about as the market was rolling over in February was to key in on that December low. If that holds, if the S&P holds above 3,800, things are just not getting that bad, and there are enough areas of the market, and for now, it's sort of the FANG and FANG-like stocks, the growth stocks, really holding things up for the major benchmarks. If, however, we would fail to hold 3,800 at some point, that all of a sudden starts to feel a lot weaker than otherwise, right? So I think we're for now bouncing off of a very important support level. I want to look at the chart of Bitcoin just to make sense of where we're at. That 25,000 level is an important one. We actually have Adrian Zadunchik coming back on the show next week, so we'll get his take on what he's seeing with Bitcoin. He's focuses on the area of cryptocurrencies. But when I'm looking at the chart of Bitcoin, again, taking a step back from the chart, nice rally over the last week, and certainly you saw a lot of noise over the weekend. It's interesting to see banks failing while we had some markets that were open and a little more active than probably on average. But weekend trading in Bitcoin certainly told us a lot about sort of this bounce off of the lows going into to the equity trading week. For now, we're once again testing 25,000. That's also the swing high from February. That's where we peaked before we rolled over and test 20,000. We're now all the way back up to 25,000 in 5 or 6 trading days. Talk about a nice recovery quickly to the upside. So overall, I mean, it's still, of course, sort of in a transition phase. You see this as sort of a consolidation range, sort of the rally into mid-January, and then sort of a broadening pattern of some sort, right? Higher highs and lower lows. But you look to see if we can get above 25,000. That happens. I think this could be a good encouraging chart. It's interesting that's happening when I'm also thinking of the challenges to risk assets, right? There are a lot of reasons going into a Fed meeting next week why arguably risk assets shouldn't be going higher if we have uncertainty and if we think the Fed may be more or less aggressive. These are all questions that I think we'll get answers to here soon. Just to finish off our market recap, I did want to look at the chart of what I call the phenomena stocks. These are called sort of the FANG stocks and the FANG-like stocks. And what I like to do is look at the 8 of these and just look at what patterns emerge. And if you wonder why and how our benchmarks are holding up, even with the financial sector rupturing, even with energy stocks over the last week, sort of breaking down and failing to hold support, how come our benchmarks, the S&P, the NASDAQ, are still doing okay? I would argue these 8 stocks, probably more than anything, tell the story as to why there is strength in our benchmarks. Our benchmarks are geared towards charts like these. They're not as weighted to things like financials, which are struggling, on a relative basis, much more. Microsoft up 4% today. Today's rally actually takes it to a new high for 2023. I don't think that's a small phenomenon. I think that's an important message to remember, right? How negative you want to be when charts like Microsoft or Apple are kind of working. And I'm seeing Microsoft make a new swing high today. I'm seeing Apple making a new closing high for the year today, and I'm seeing this potential sort of consolidation, a bit of a higher low right above the 200-day. We're kind of right at that point where we're making a new breakout to the upside. That measure is much higher. That basically would say go back at least to the August highs if you think of the move going into this consolidation and coming out. So how negative do you want to be about our benchmarks when some of the biggest mega cap names, the biggest weights in those benchmarks are looking pretty constructive? Now, it's not all perfect, right? Netflix still above its 200-day, broke recently below its 50-day, bouncing higher this week, but overall I would say still a little bit more to prove. Amazon making a higher low in March, but again, a very different contour than some of the other charts that we've been talking about. Arguably, one of the more constructive ones we get to here would be Meta, right? We highlighted Meta and AMD as 2 examples of stocks that had gapped higher in February, pulled off a little bit after that gap, but then settled into a clear support level. Meta's holding at 170, right? And now again, making a new high for the year. So you have a number of these mega cap names. Again, the leadership traditionally in a bull market phase led by some of these growth areas of the market. Can the market rally without those names? Of course. Could these names go down and our benchmarks go up? They could, but it would be tough. And it's because of the way that they're constructed, there's such a big weight. But overall, I see a lot to like with some of these charts continuing more of a bullish phase. Let's take a quick commercial break. We'll be back with today's guest, Mish Schneider of MarketGauge. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Welcome to the show once again from our brand new studio here in Redmond, Washington. We are super excited to build on the capabilities that we have. We are just scratching the surface of how we can use this space to better illuminate and educate and inform you about what's going on. We're excited to do it. A couple quick announcements before we bring on today's guest, Mish Schneider. First off, we're going to do a mailbag segment on tomorrow's show, and we'd love to feature one of your questions live on the air. You can reach us via email, thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll hope to hear from you soon, and I answer your question live on the air on Friday's show. Upcoming schedule, we have some really good guests here. I'm excited to talk to Mish Schneider here in a few moments. Next week, on Tuesday, March 21st, we have Samantha Leduc, founder of Leduc Trading. She's going to help us sort of get through this minor issue called the Fed meeting, which will certainly be a big area of focus. I am actually taking the second half of next week off, going to Disneyland with my family. And my friend Julius DeKempener has generously offered to guest host the show once again. He has a couple guests that are really, really solid. Bob Lang of Explosive Options will be coming through on Wednesday. Then on Thursday, Adrian Zadunchik, founder of the Birb Nest, coming to us from Portugal. Also want to let you know about the upcoming event at Market Misbehavior. I'll be doing a webcast coming up next Tuesday called Charting a Financial Crisis. We're going to be talking about some of the ways that we can chart what has happened, how we can try to put a good historical context into what has been going on, and then look forward and focus on what charts can help us navigate sort of this path out. We'll be talking about the Fed meeting. We'll be talking about the banks going under, all the other ripple effects of what we heard about, how it's a focus on bonds and interest rates. To sign up for that free event, go to marketmisbehavior.com/crisis. Let's continue on with our show today with my guest, Mish Schneider. Mish is the Director of Trading Education at MarketGauge, coming to us from Santa Fe, New Mexico. Mish, it's a pleasure to welcome back. How are you?
I'm great. How are you, Dave?
Hanging in there. We talked before we went live. It is a challenging market, right? And it's a volatile market. There are a lot of movements, and I know a lot of people are just struggling to sort of get their feet under them as investors and just kind of get a sense of how do we put this into context? How do we understand what's happening? Your first chart that you shared with me, I think, is brilliant because it combines some of the key market measures that you track. Can you talk us through these 4 charts and what it tells us about the environment here?
Well, I know that you talk a lot about time frames, so I always like to step back because this time frame has been extremely important this year in particular, and this is the monthly time frame where you're looking at two moving averages, a 23 month, which represents about a 2-year business cycle, and then the green, which is the 80 month, which represents about a 6 or 7 year cycle. In all the years that I've been trading, I don't think I've ever seen so much emphasis on these two moving averages. And it's logical, right? Because we had 2021 way up, 2022 way down, and 2023 is still trying to sort it out. Are we going to go into an improvement in terms of an economic cycle? And or are we going to eventually break down under that green line or under the 6 or 7 year cycle, which would put us into a much deeper recession? And at this point, we don't know. But here's what we do know. Looking at the semiconductors, obviously that's being challenged right now. March doesn't end till the end of the month, so this is the mid-month. But nonetheless, we got through the Ides of March, and we're peaking out above that 23-month moving average in the chip stocks and the growth stocks and a lot of the FANG stocks. Now, that in and of itself would be like you, Dave, taking your family to Disneyland if you just look there. But there's other realities going on, and I think these realities have to be kept in the mind. And again, another brilliant point you made before I came on, which is really understanding your risk reward, right? So if we move to the right, then we're looking at the Russell 2000. Now, by now, people know this is what I consider to be the granddaddy of the U.S. economy, because a lot of these chip companies have international presence. A lot of them buy back their own stocks. But these 2,000 stocks that are in the United States, they're small cap. They don't have the same amount of money as an Apple. For example, and they may experience layoffs, but it's not going to be like hearing Amazon laid off 18,000 people, which is just really a nothing compared to the size of Amazon. This really represents the economy. So look what is happening right now. It has not been able to get through the 23-month. And up until today, it looked like it was starting to challenge that 80-month. And how many times have we been in a situation where the chip stocks keep running, only to look around and realize, whoops, the economy is in not such good shape, and everybody gets nervous, and then those start selling. So it's going to be what happens first. Does the confidence come back or not to the Russells? Right now, we saw a bounce today. Let's see what happens. But to me, this is really still very much trading range. If we move down below that, this is granny, retail, right? Consumer. 68% of the consumer, of the GDP is the consumer. So same kind of thing, almost mirroring the Russells, although in a little bit of a better shape because it's still above the 200-week, whereas it looked like IWM was going to test it. But again, with all of this confidence we're seeing in the chip technology, we're still not seeing a lot of money coming into the discretionary consumer space. Money's mostly coming into the consumer staples because people have to eat and they have to buy certain things, which of course then takes, and by the way, IYT transportation demand looks very similar. It actually broke the 200-week moving average yesterday when it traded at 218 IYT, came back a little bit today, but the week's not over yet, right? So tomorrow's going to be very interesting. And then finally here we have the regional banks. So again, the regional banks never ever took out the 23-month. And if you look at a weekly basis chart, by the way, it also started to break down under the 50-week before anything else did 3 weeks ago. If you don't think price tells you something, somewhere along the line, there's somebody smarter than all of us reflected in the charts. This is a great example, right? So now we can see the result. So the question is this. I think you put this all together, and this is one of the more disjointed situations within our economic modern family I've ever seen, which makes it challenging, obviously, makes it optimistic, depending on where you look, but also makes it a little bit scary because the knee-jerk reaction into the big growth stocks partly has to do with the fact that it looked like, once again, the Fed and the government saved the day with the banks. But there's a consequence to that, obviously, because there's money being printed. So that's kind of really where we're at right now, looking just here.
It feels, to be honest, like the modern family is having a little family disagreement in some ways, right? You have the good, the bad, and sort of the indifferent, sort of the caught in the middle, right? And it's interesting when you look at the chart of the S&P 500, while it's chopped around quite a bit, really hasn't gone anywhere directionally in quite some time, right? It's sort of sideways, and it makes sense to me that you're getting sort of these winners and losers in the middles, but in the end, it's kind of netting out to a choppy environment, to be sure. You brought up interest rates, and of course, we've had a lot of a focus on the bond markets this week. Next week, we have the Fed meeting. When we're looking at your chart of the TLT, what does that tell you about the conditions now and what we should be expecting going forward?
Well, this is a daily chart, so now we've gone to a much quicker time frame here. And by the way, yes, with the SPY, we know 420 is a 23-month. With the Qs, by the way, it's 328. So we still have quite a trip to go to even get there. So that's something to keep in mind too. But the TLT charts are very interesting because I saw your tweet this morning, which is what made me want to talk about this with you, because you're obviously looking at this very closely as well, as everyone should, with a Fed meeting coming up. And also, chip stocks and growth stocks do not like higher rate environment, and the rates were coming down. And then, of course, today, now the opposite happened. The rates actually went up, or I should say the yields went up a little bit. So look what happened. You want to talk about a technical, beautiful picture. We got right up to the 200-day moving average. And like you said, nothing good happens under the 200-day. Today, nothing good happened in terms of the TLTs. But it's still holding the 50-day, which is great. But what's interesting to me is if we go below to the leadership chart, that red line represents the SPY, and it is still outperforming the SPY, which is more of a risk-off environment, number one. It's more indicative of a flight to safety in case of a recession. So the TLTs today told us, okay, we have to go down because look how great everything is. But ECB raised by 0.5% today, which was a shock considering the vulnerability of the bank. And if we think that maybe Powell will go in the same direction, then TLTs will obviously reflect that by going lower. And if they don't go lower and he still raises, we're going to see the growth stocks totally go down. So here we are, once again, dancing between Disneyland and a shop of horrors. Now, in the bottom chart, we actually have also a good performance by the TLTs. They are above the 50 and the 200-day, so there's a divergence, right? Because in this case, the 50 being above the 200 is bullish in the real motion or momentum indicator, while we're still not 50 above the 200 in the price. So that's kind of why I think the TLTs are going to be another key here to watch.
Can you talk a little bit, Mish, we have about 2 minutes left, but when heading into the Fed meeting next week, when you're thinking of positioning, when you're thinking about risk versus reward, do you have a general way that you approach a Fed meeting given the volatility, the excessive volatility, and certainly the uncertainty, the unknown about what's happening? Do you have a certain way that you try to approach that? Have a general narrative that you think is going to work and position for that, but just be ready for some huge opposite move coming in? Or what would you tell people that are still trying to make sense of a week like next one?
Well, I think if you start looking at every single Fed meeting that happens, you would go crazy trying to readjust your entire portfolio. So I think you actually have to look at the overall trend of where the Fed is going and listen to what Powell is saying. He is not dovish by any means. He's looking at labor. He's looking at PCE, not so much CPI. So that tells me right now that he still plans to stay the course in terms of rates, so that I don't think I would make any necessary adjustments, except for the fact that there's one other factor, and that is the dollar. Because the yields went up today, but the dollar went down a little bit. And I think that people are very complacent in terms of what the dollar is supposed to do. And I'm a little bit worried here. That's probably my most worrisome case right now for a lot higher inflation, is if the dollar continues to fall before the Fed starts catching up with raising rates. Stay the course is very different than becoming overly hawkish.
It's such a lot to try to think about. And a great guidance to think about the dollar chart, by the way, Mish. It's a really good place to leave it. It is so good to see you, Mish. Thank you so much for coming on the show. I appreciate you sharing some charts, particularly those monthly charts of the modern family. That was a brilliant way to try to make sense of this. Be well and stay safe there in New Mexico. We'll talk to you again soon.
Thank you so much, Dave.
That's Mish Schneider. Mish is the Director of Trading Education at MarketGauge, coming to us from Santa Fe, New Mexico. I love being able to ask someone like Mish how you approach a week like the next one. I know there's a lot of uncertainty. If you weren't anxious about what we might hear and how things might evolve because the conditions are so fluid, certainly the conditions and the events in the last week have probably not helped. But I think just thinking about, not necessarily trying to do a deep history lesson, but just focusing on the evidence, focusing on the weight of the evidence, and really listening to what we hear, and just trying to think about what those impacts might be, I think is really good suggestions, really good guidance from Mish Schneider at MarketGauge. We need to wrap the show, folks. This goes by so quickly, but we're enjoying it a great deal, and we're going to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. In honor of my guest today, Mish Schneider, with a background in agriculture, I had to bring up something like sugar just to sort of shake it up a little bit. This is a new chart. I think it's really going to take off. It's going to go viral, called Sugar and Semiconductors. 2 obvious charts which look very similar, and I say that with a great deal of sarcasm. It was funny when I was looking for ETFs that were actually ranked pretty high using our scooter rankings. That's the StockCharts technical ranking. 2 in the top 10 ETFs were sugar and the ticker CANE. C-A-N-E is the Tukrium Sugar Fund. We've talked about their corn and other wheat and other contracts before, but again, showing nice strength. And I'm just showing the price relative to the 50-day moving average. If you didn't know all of this was happening in the last week, if you didn't know banks were going under, people were concerned about the deposits, market volatility was fairly high, you wouldn't know it. Looking at the chart of sugar, it looks like this nice, consistent uptrend, right? We're talking about a nice sort of consistent move to the upside. It reminds me a lot of the chart of the SMH. Both of these, again, rank in the top 10 of our entire ETF universe using our proprietary StockCharts technical ranking model. But I like how both of these are trading higher. I particularly like how semiconductors have pulled back to an ascending 50-day moving average. I'm not surprised that my guest, Mish Schneider, was talking about semiconductors. That's part of her main way of thinking about the market environment. We've highlighted names like AMD and NVIDIA and others showing a lot of strength. So the SMH, I would argue, still showing plenty of strength to be had. Chart number 2 of our 3 and 3 is a general chart looking at offense over defense. I was talking with Grayson Rose at StockCharts here earlier today. We're talking about a number of different charts and thoughts, and we were talking about different ways to measure offense versus defense. And this is a chart I put together to sort of illustrate some of the things that I've liked to look at. So from the top, we have consumer discretionary over consumer staples. In the last 6 weeks, certainly heading lower. But if you are bullish, and which I am not necessarily all bullish here, I'm super skeptical of market upside, but I would become less skeptical if this line would turn higher. It's not yet. The equal-weighted version, which is the second panel, also trending downwards over the last 6 weeks as well. 2 others. This is hotels versus utilities, and this is the relative strength of utilities flipped upside down. So if this line is going down, the utilities are outperforming. If the line is going up, utilities are underperforming. So you're looking at a traditional measure of the performance of a fairly defensive sector. I would argue over the last 6 weeks, all 4 of these showing more negativity than positivity, which sort of drives home the challenging environment we're in right now. However, you look to see if and when these turn up. That's where I think an offense versus defense chart can be really, really valuable, just to see when the conditions have changed enough that you can't deny it. Final chart, Caterpillar. Just looking at random names that were making a new swing low. So Caterpillar making a new 3-month swing low this week. It came up on my scan that I was running for my Market Misbehavior Premium members yesterday. And I was looking at the chart in a little more detail. What's interesting, it's sort of right at that sweet spot. It's dropped quite a bit, 100% true, right? From 265 in late January, down in mid-March to around 215, right? That's quite a bit of a drop. That's losing 20% of its value very, very quickly. It's right at the 50% retracement and also just above the 200-day moving average, which means to me, as long as we hold that 210 level, things are not too bad. If we break that 200, the next level of support potentially, but I'm watching at the fact that the RSI is oversold as we're nearing a potential support level. Is this the place where a chart like CAT starts to bottom out? Folks, that's a wrap for this show. Thank you so much for joining us every weekday after the close. Special thank you to Mish Schneider of MarketGauge. For StockCharts in Redmond, Washington, I'm Dave Keller. We'll see you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.